and had the Justice Department come after J.P. Morgan for what they were really guilty of, suppressing the price, it would have led to untold civil lawsuits against J.P. Morgan. So they kept the charges to these, I say, minor and technical spoofing charges, which is very hard to prove damages. So they kind of let J.P. Morgan off the hook because the alternative was unthinkable, putting them out of business in essence. I do foresee, and have for some time, but more so now than before, a shockingly higher price for silver, and to a lesser extent for gold. That's the one thing that is going to impact us all more than any other single thing.
Some people call them constitutional silver 50-cent pieces. Some people call them 90% half dollars. But at only $2.39 over spot, can you really call them junk? That's right. We've got 90% junk silver half dollars at only $2.39 over spot, now through October 17th. So if you want real silver and increased liquidity in a coin minted by the United States Mint, look no further than these 90% silver half dollars at only $2.39 over spot. 90% silver, 100% a good idea. To get started, email your name and phone number to libertyandfinance@protonmail.com. That's libertyandfinance@protonmail.com, and we'll get right back to you. 90% silver half dollars at only $2.39 over spot, now through October 17th.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest who has been involved in the silver markets from the beginning, as far as most of us are concerned. This is Ted Butler. He's a legendary analyst of the COMEX market and all things having to do with the physical precious metals market. Ted, thanks for joining us again here on Liberty and Finance this Thursday, October 8th, 2020.
Thank you, Donegan. Glad to be here.
We're privileged and honored when you can join us. Our viewers may never tire, as I don't, of hearing that you were the first analyst that got me involved and interested into precious metals in the first place. I was sent a physical American Silver Eagle, the first one I'd ever held and touched, from a local dealer, and together with a copy of your Butler Research letter. And wow, did that open my eyes. So people go to butlerresearch.com and you'll find out all about Ted's latest analyses. We had you on a couple months ago when there were both you and also Bill Murphy from GATA.org were talking about a changed behavior, a changed trading pattern on the COMEX that seemed to be a break from the past as far as the ability of certain players to manipulate the price, or perhaps the emergence of a desire for physical delivery on the part of enough players that the dynamics were changing on the market. And we want to get to that as soon as we can. But first, if you could just bring us up to date on the very latest that's been happening on the J.P. Morgan Department of Justice indictment and fining and so on, and tell us what you think the most important takeaways are from that people need to be aware of.
Well, sure. On September 30th, the Justice Department and the CFTC jointly announced that they had settled the 2-year investigation and charges against J.P. Morgan and his traders for spoofing/manipulation of the precious metals, specifically COMEX, silver and gold mostly. They gave them, the Justice Department agreed to a $920 million fine, the largest in CFTC history, and agreed to a deferred criminal prosecution with J.P. Morgan. The fine, while a lot of money, just close to $1 billion, is basically chump change for J.P. Morgan and no more than a wrist slap. The deferred prosecution agreement is something different in my mind. It's only one step or 1 degree different from a actual criminal indictment or a criminal charge against the bank. And had they done that, had the Justice Department found that or charged that and took them to court that J.P. Morgan was criminally involved in manipulating the silver market, it stood a chance of eventually, putting the bank out of business. The Justice Department just can't charge a financial institution with criminal fraud and behavior without serious repercussions. The last such, to my mind, criminal criminal indictment that the Justice Department brought against a major financial institution was the accounting firm Arthur Andersen in the Enron scandal. And it put Arthur Andersen out of business. So they've learned from that, the Justice Department. I think there's been some deep regrets that Arthur Andersen was eventually put out of business as a result of the charge. They're not going to do it again. They're not going to charge a major bank with a criminal charge because it runs the risk, and I'd say almost the certainty of eventually putting them out of business, and that's like the last thing anybody wants. So one step up from that is a deferred criminal prosecution agreement, which basically says you're on probation, you're on parole, you better behave yourself for a certain period of time, a few years, and then we'll forget about the whole thing. We'll expunge the record or whatever. And that's about the most serious thing that the Justice Department can do, and they did do that. So it's not a walk in the park or a minor wrist slap. It allows J.P. Morgan to stay in business, but the alternative was unthinkable. We can't imagine what it would be like if a major bank, perhaps the most important bank in the world, in the country anyway, J.P. Morgan was put out of business. It's unthinkable. So this comes close. The other thing was the Justice Department and the CFTC shied away because they didn't want to go there from charging the bank, J.P. Morgan, with what they were really guilty of. What they were really guilty of was basically leading the price suppression of silver and gold ever since J.P. Morgan took over Bear Stearns back in 2008. And had the Justice Department come after J.P. Morgan for what they were really guilty of, suppressing the price, it would have led to untold civil lawsuits against J.P. Morgan. So they kept the charges to these, I say, minor and technical spoofing charges, which is very hard to prove damages because the average trader is not in the market on a very, very short-term basis. And so they kind of let J.P. Morgan off the hook because the alternative was unthinkable, putting them out of business in essence. But there's lessons to be learned, and there is every expectation that I have that J.P. Morgan is going to watch its P's and Q's for a while, and I think that bodes well for the market. For the price of silver and gold moving higher, and that's my takeaway.
Just 2 points of clarification I need. One is you mentioned that they stopped short of actually indicting J.P. Morgan, but previously, several months back, the DOJ actually did directly indict, was it 6 or so specific traders at their gold and silver trading desk? Is that correct?
Yes. Well, a couple pleaded guilty, 2 pleaded guilty, and as part of this announcement, criminal charges are still open and pending. It's going forward against 3 or 4 of the other traders that were not part of this settlement. So that's still, to be resolved. It could be, they could reach some kind of settlement, but it's scheduled to go to trial sometime next year. But that's the traders for J.P. Morgan as individuals, not the bank itself. They're kind of off the hook now.
That leads to the next point. That's I think the big takeaway from this. When you talked about the recognition or the realization of the actual damages that would have been admitted had the actual manipulation of metals prices been brought and made to stick, is you think about all the mining companies, all of the investors, all the investment funds, the pension funds, and everything. It's like when you think about what's unthinkable, that's huge what the impact could have been. But then the other bombshell that you mentioned was this: we've heard about too big to fail, but some people jokingly, but not so jokingly, call it too big to jail. And it's like, what the heck? So if you get to be a big enough fish, it's unthinkable to hold you accountable for your crimes. I mean, what kind of future does that bring us towards?
Well, it's reality. I'm not condoning it or basically putting a seal of approval, but it's reality. These banks are too big to fail, too big to jail. These are big, giant organizations involved in every aspect of our financial system. It ain't a perfect world. I'm in agreement with you.
Man, backing away from that a long ways and thinking about any learning that we've done about people who are trapped in abusive situations or that sort of thing, just making a metaphor in my mind here is that when someone seems to be all controlling and all powerful in your life, and then they have you under their thumb, and even though there's wrongdoing, and how many organizations have been like this? You can go down the list of major organizations where there was wrongdoing that was being done, it was being shuffled, or a blind eye turned towards it, and even people who were inside the organization and knew it was wrong weren't speaking up about it because they felt like they had no other alternative. And it seems like, oh man, this is so emblematic of the most dysfunctional and toxic type of structure that we're allowing to persist officially. It's just chilling. People say, "Oh, you're a conspiracy theorist," and that doesn't seem what it seems like. It seems like this is really what we're facing here. And then the question is, how does an individual move forward in their life if that's actually the environment that we are in fact working with? And I guess in that context, could you take us to the next chapter, which would be your assessment for the last couple of months and going forward of what you see as the major market dynamics happening on the COMEX? People have been talking about extreme increases in demand for physical delivery. People have talked about measures that the COMEX has taken to try to extraordinary measures, unprecedented, to try to resolve the demand for physical through London or through bring on additional mints or that sort of thing. But looking at that, could you give us your assessment as well as what you see forward towards the end of the year with the December delivery month approaching and that sort of thing, whether you think there'll be anything meaningfully different that will come into our lives because of the difficulties that the COMEX will be facing to meet the demand for physical?
Well, about the most meaningful thing that could impact us all is I do foresee and have for some time, but more so now than before, a shockingly higher price for silver, and to a lesser extent for gold. That's the one thing that is going to impact us all more than any other single thing. You're mentioning a lot of the two important things that are going on, that have been evolving, that I pay most attention to. One is the physical side of the equation, which is different in silver and gold, and then there's the paper trading side on the COMEX, which actually sets the price. And the two of them have been, very unusual changes afoot, and I think you will see it eventually, and not in the too far distant future in the price itself. That's going to be the final thing that we'll all see. Physical has been crazy this year. We've had phenomenal amounts of physical silver come into mostly the ETFs, SLV, and some of the others. I mean, to the tune collectively of close to 300 million ounces, which is a substantial amount. Recently, we've had included in that, we've had a 50 or 60 million ounce increase in the COMEX warehouses. In addition to the movement that we've talked about before, there's been a net addition of 50 or 60 million ounces into the COMEX warehouses over the past 2 months. And so these things taken together, prior to that, we had like close to a 30 million ounce increase in gold, which is very substantial in the COMEX warehouses, and another 20 or 30 million into the gold ETFs earlier this year. You either have to look at these large increases in holdings, visible holdings that we can see, as either surplus metal that nobody wants being dumped into the market, dumped into the exchanges, dumped into the ETFs, or you look at it like it's coming in because it's being demanded. And I would say, and I think a reasonable person, that the big increase in physical metal deposits and deliveries have basically been driven by demand rather than excess supply. So we'll call that bullish, and it is very dramatic. On the other hand, I think the biggest change, something you referred to earlier, was a change in pattern in the positioning of futures contracts on the COMEX. Over the last year, mostly in gold, the very biggest shorts, I call them the 8 big shorts because that's how the Commodity Commission classifies them on the daily, weekly commitment of traders reports. For the first time in 3 or 4 decades, 35 years or so, we didn't see a big increase in additional short selling in gold once it crossed above the $1,400 mark a year or so ago in the summer of 2019. And I believe the lack of this additional selling, short selling, which we always got prior to that when gold prices rose, the fact that the 8 big shorts did not add to their short positions is what enabled the price to run another $600 or so to over $2,000. And even today, they're not showing signs of increasing their short position as prices rally. In silver, it started in July mostly on the big rally up. The big shorts, the 8 big shorts, did not add to short positions for the first time ever, and that resulted in the price quickly running to close to $30, and we've subsequently pulled back. But the change in pattern is that the 8 big shorts seem to be reluctant to add new short positions on price rallies, and that's the key. If they don't add on the next leg up, whenever that begins, which I think could be very quick, very soon, then the market's going to rally strongly if they don't add shorts. If they do add shorts, then we might be back into a situation where they're going to do everything they can to keep the price from rising. But we're not there yet. It's an open question. It's the most important open question. And will they or will they not, these 8 big crooks, commercial banks, J.P. Morgan is not short anymore, so that's going to be a wild card in the whole thing. The fact that they're not short on the COMEX in either gold or silver as we speak is very encouraging, because if they don't come in and help out the 8 big shorts, these 8 big shorts shouldn't be able to do it by themselves. But we have to see this evolve in the future. We'll get the answer one way or another soon enough.
On that same topic of a metals price breakout. We have a question specifically from a viewer. Steve Bond says, Ted, love your work. As a 45-year investor in the gold-silver space, what should I look for as the signs of an imminent breakout in prices of the metals and shares?
Well, what I just said, it's a great question. Basically, when we start to move up, say we break out above where the 50-day moving averages are right now, which is around the 1950 mark in gold and the $26 mark in silver, using COMEX December as the benchmark reference. We take out those prices on the upside. You'll want to pay attention to what the 8 big shorts are doing. If they're adding shorts, new shorts aggressively, not minor amounts, but substantial amounts, many thousands of contracts, you want to start looking perhaps over your shoulder, or you have to calculate maybe these guys are going to be wrong and get blown out of the water. But if they don't add shorts, then I would think it's almost clear sailing for much higher prices. That's what I'm hoping for. That's kind of what I'm expecting. But if you're looking for what I'll be looking for is what these 8 big shorts do.
All right.
And I'm kind of betting that they won't add, but I don't know that for a fact.
There's another question from a different perspective. Online Advertising Net says, is the best time to purchase gold and silver after the impending stock market collapse, which will pull all assets down? So this is interesting because I'll put a little sideline in here. As a precious metals broker myself for Miles Franklin, I have a number of clients who are waiting. They're ready to make a purchase, but they're waiting for a major smackdown before they do. And I have others who are wanting to sell, and they're waiting for a run-up in price before they do. So I've got 2 camps of people who are each waiting for the opposite thing to happen. But anyway, this question is zooming in on, do you foresee, in the event of an impending stock market collapse, that we'll get a major drop in the metals prices that will be an entry point if people have been waiting for that?
I don't see it that way. That doesn't mean it won't play out that way. I mean, I don't really look too much. I kind of expect. I wouldn't be surprised if the stock market tanks one of these days. It seems inflated to me, but that's not my area, so I wouldn't want anybody to rely on that. Other people are looking for the dollar to collapse, and that'll be a signal for gold and silver. I never understood the dollar connection, to be honest with you, with precious metals, even though it's widely accepted. Look, I think it comes down to if you think that the price at the current levels presents value. I don't know if I would be waiting for something to happen to convince me to go in, only because I can foresee, I can't guarantee, but I can foresee that when the price of silver does begin its genuine up leg that many of us, including me, have been expecting for a long time, I'm afraid that the move is going to be so quick from the get-go that waiting for some type of a signal is it may be self-defeating. If you think it has value, why wait? I see a lot of things lined up right now, including the market structure on the COMEX. The positioning of the various categories of traders as being quite bullish right now. And while I can't rule out a leg down for whatever reason, the price is set in a somewhat corrupt way as it is. So I can't rule out a price sell-off, but at any time. But it seems to me it might be self-defeating to wait for some clear-cut signal, because when you get that clear-cut signal, it may come at at a substantially higher price. And that's, just to keep it simple, the idea is to buy low, sell high. I think it's low. So I wouldn't hesitate to buy here. And I won't say that if it does sell off that I won't, scrape up a few more shekels to buy more at that time. But it's good enough as it is. It's cheap enough as it is. It's undervalued. All the signs point to a much higher price. What the heck do I want to wait for?
Another thing that comes to mind for me personally, having just lived through this, because again, I'm a newbie at being a dealer, so I've been watching this more closely than ever before. But back in March, when we had that flash crash with the stock market down, 35% in 9 trading days or something, and the metals went down significantly as well. I mean, the spot price did, but the physical premium ballooned to just fill the gap. In other words, there was this clear separation between what people and dealers and mints and major wholesalers were willing to part with physical metal for versus what the spot price happened to reflect on that day. There was a disconnect between the two.
For certain forms. I mean, if you're dealing in 1,000-ounce bars, the standard industry unit of trade for, say, the ETFs or the COMEX futures contracts, it followed. I mean, the wholesale, the COMEX price went down, the ETF price went down too, and it did follow the stock market, and it is following the stock market today. I noticed recently that there's some kind of a correlation between higher stock prices, higher metal prices, and vice versa. I don't think it makes any sense. I think it's a correlation, a coincidence. I don't think it's cause and effect or a causal relationship. But these things crop up all the time. The idea is to, Mr. Market makes things difficult for all of us. It's not an easy road generally, and there's potential pitfalls and roadblocks out there that are designed, I guess, to confuse you as to what's really going on. When I look back at that big break, sell-off back in mid-March when the price of silver dropped from 18 to under 12, a very substantial drop, and a similar drop, not as extreme, in gold, a couple $100 in gold. What I focused in on the stock market happened to decline at the same time, and I think it's a correlation rather than a cause and effect. What I see as the big cause and effect was that J.P. Morgan, before the sell-off, at the highs in February, was very heavily short gold, 45,000 contracts, something like that, close to 20,000 contracts short, 100 million ounces equivalent in silver. And then on the price decline, the big price smash, J.P. Morgan bought back every one of its massive short positions on the COMEX. And to me, that was the reason we went down, because the crooks at J.P. Morgan needed to cover their short positions. They knew these Justice Department investigations were coming to a head, and they wanted to clear the decks kind of thing. So, and they haven't put it back on. They haven't added shorts in a substantial manner or hardly any manner at all since then. And I think that's one of the best things about indicators for higher prices is that J.P. Morgan, the crooks at dirty, rotten son of a guns, crooks at J.P. Morgan, are no longer short the market. And if they were heavily short the market, I might be singing a different tune, but I don't have to, because they're not short right now.
When you talked about the surprising correlation recently between metals and the market, it's interesting because we heard that there was a study that came out. I'll see if I can dig up a link to it. It may have been by Harvard, comparing asset classes historically and which ones were correlated versus anti-correlated. And it determined that gold specifically, but precious metals were the only asset class that was negatively correlated to equities or a stock market going forward. Historically, it had been bonds and stocks that were considered to be safety plays against each other. You could shift more of your asset into bonds in order to reduce your exposure to stock market volatility, that kind of thing. But recently, with all the manipulation by the Fed buying up everything in sight, the bonds and stocks have been positively correlated to each other. So it's no longer a valid diversification strategy to get into bonds to protect yourself from stock market ups and downs. And that leaves metals as the only hedge left in town that you can hold on to as insurance against stock market declines. But the thing that seems to tip us out of this positive correlation that you're observing currently into that anti-correlation that actually provides the insurance seems to be a psychological shift on the part of investors to get their heads out of the dollar paradigm and realizing when they are doing a risk-off move and really trying to hedge against uncertainty and potential loss of value in the currency and in the stability of the banking structures and that sort of thing. That's where it seems then gold and silver take a life of their own that's completely separate. Once people realize they are a different animal and they have a life of their own that is separate from the markets and the major financial institutions.
Yeah, no, I don't argue at all. Maybe another way of saying it is that, look, if you knew you had to go on a long cruise or get stuck you knew you were going to get stuck on a deserted island for the next few years, okay, how would you arrange your financial affairs before you hit your desert island? I would think that I'd be real comfortable holding silver versus just about anything else if you knew that you couldn't change it for a few years or something like that. So maybe that's summing up kind of this long-term correlation that you're talking about. Where would you want your money if you had no choice? Okay, for the next 5 years, you had to decide now. Okay, and you couldn't change your mind for a few years. Look, I wouldn't lose much sleep about it. I'd have everything in silver.
We've been talking about the roles of the major banks, the big players, and how they sway, too big to fail, too big to jail, whatever, too big to influence the market other than through their decisions, their actions. But there's a question from a viewer, Jim Jones, who says, how do the gold and silver owners throw the system a curveball? There's certainly been talk in the past about how we should do a boycott of the, people. If everybody just went out and bought an ounce of silver, whatever, it would create such physical demand, it would break the manipulation or something. Do you see a role there for ordinary investors or even investment funds or pension funds or whatever to, by their actions that they make now, retail investing or institutional investing actions, actually impact the trajectory of this, or are we all just watching for the big fish to make their move?
Well, that's an interesting point. I would look at it that is going to occur, and you are going to see a massive move into, or an attempt at least, to buy into precious metals. I don't think it's going to become reality based upon any conscious, organized effort by massive numbers of people that get together and agree that this is what should be done. I think it's going to be explained with the price going higher. There's something about a price going higher of an asset or an asset class that mobilizes investors to buy collectively. I don't care what it is, stocks, bonds, real estate, precious metals. When the price goes up, everybody wants to buy. So in this particular case, when the price of silver and gold go to high enough levels, you're going to get the collective investment buying, which is only going to fuel it more automatically. That's just human nature. So I don't think we have to sit down and worry about organizing people to see the merits of, say, gold or silver, the price will do it for us.
It's interesting because I know exactly what you're talking about, sort of the herd instinct. We really we do have that deeply ingrained in our instincts, that when we see a flock turning and wheeling, you go, "Oh, I got to be part of that because that's where we're going." And interesting though, I think this correlates back to something you said earlier about you said buy low, sell high, and you think we're low. It's interesting because the corollary to that would be if things were rich and if things were, for metals, high priced, then similarly a downward move would be a cascade starting people flocking out. And that's absolutely not what we've been seeing. Again, I'll testify on my recent experience as a new broker is that when we get a dip, these mornings when we wake up and silver's at 23 or something like that, the spot price, my phone is ringing off the hook with people buying, because we help people buy or sell. They could just as easily tell us if they want to sell. Very few, maybe 2 or 3 people have sold on those down days with me in the past 6 months, but the phone is ringing off the hook with people who are wanting to buy on those down moves. So if that was just I think that's almost a testimony to the instinct of the herd saying, we know that this is a low and we're looking at this as an opportunity, rather than, oh no, we're starting this down cascade and we're going to be part of that.
Yeah, no, I maybe in different words, we haven't really moved yet. Okay, so the people that are interested in are people generally that have done their homework and they understand and they can feel the intrinsic value at this at current levels. What I was talking about is later on, people that are not going to pay attention to the details that closely. They're just going to follow the price. The price is going up, if you want to call it the fear of missing out, whatever you want to call it. That's when you get the real collective buying in any market, is once the price has firmly established itself as going higher, which hasn't happened in silver. It's happened a little bit in gold. Because gold is recently hit all-time highs, whereas silver is still substantially below its all-time highs. But when silver is at all-time highs, over $50, say, that's going to attract people to the market to buy it, not because they've sat down and studied the details and the fundamentals in the background. Heck no, it's the price is going higher. That's all the hell you need to know. And that's all most people generally need to know. If the price is going higher, that's all the validation that you need. And we're not at that point yet. So that's why I say, buy low, sell high, buy, while it's low, before it becomes obvious, to the masses that this is something we should be in. You're buying it before the price moves.
Right. We've got this final question. It's more of a comment of appreciation, but there's a question hidden in there from James Mayo for you. He says, Ted, I appreciate all of the time and work that you have invested in the exposure of manipulation. Any prediction of when or if it will ever end? It's exhausting. I don't know how you lasted this long.
Oh boy, that's a good one. I don't either. It's like it's taken on kind of a life of its own. I think it's going to end soon. I mean, I always think that. If I thought it was going to, end only 3 or 4 years from now, I would say so. But all the signs that I see and everything that's come along over the last 30 years or so has basically put an exclamation point as a confirmation that the basic premise that I've held, namely that this market, silver market specifically, has been held down and suppressed, by concentrated short selling on the COMEX, and it's every I has been dotted, every T has been crossed. We've come so close to the final blow up, including this recent Justice Department agreement with J.P. Morgan, that it can't be much further. It's like we're running out of, it looks like, physical metal that can be easily bought on the market, and the configuration on the COMEX, I say very soon. I've said it before and basically been wrong. We haven't truly exploded in price, but it hasn't, when you look back from where it started, the $4 or $5 mark, there's no real apologies necessary. Unless you bought, at every extreme peak in the past, which I'm not advising. I've never advised people to do. It's a weight. There's no question about it. But there's been powerful forces on the other side that have prevented it from going up, and that's the clearest explanation. Those forces seem to be dissipated, and I don't know what, there's only one group, a narrow group, I call them the 8 big shorts, that actually are opposed to higher metal prices, okay? Everybody in the world, certainly the people that own the metal and the miners, everybody wants higher prices. And there's only one very narrow group of people, traders, these 8 big banks, I call them, that are on the other side. And sooner or later, they're going to get blown out of the water. The miracle is it hasn't happened yet, but it's so lopsided. You got the whole world, in a sense, rooting and expecting and cheering on higher prices, and you got this very narrow group, 8 crooked banks, okay, that are resisting, the will of the rest of the world. That's nuts, and that can't last forever, so I think it's going to end soon.
Something that you just triggered in my mind is this idea of surpassing previous nominal all-time highs. And for silver, again, that would be approximately $50 per ounce set back in 2011 at the previous peak. But we've spoken with John Williams from shadowstats.com, and he's not only done extensive work on the true rate of inflation, but also comparing that with the Chapwood index that Alistair McLeod talks about, would set the rate of inflation at roughly 8 to 9 to 10% annually. So if you take even the low end of that 8% over the past decade here since that last high, actually using my engineering background, the rule of 72 for exponential growth and decay, if you divide 72 by that interest rate of 8, you'd get 9 years. So it's been 9 years since the previous high in 2011. And in that case, that means you should have a doubling. So the nominal new target, just to get even, if everything else had stayed the same, just to get even with that old nominal high would be like $100 an ounce for silver. But with all the expansion of debt multiples and trillions in the currency and so on, some people are saying we're much the same factors that were present in 2008 and 9 that drove that uncertainty and that popular sentiment of rushing into silver and gold are all much bigger forces now. So what's your view of sort of that inflation-adjusted range of potential future prices for metals?
Well, that's I'm not going to argue with any of that. I mean, it's like I think we're going to take out 50, we're going to take out 100. How much higher we go from there is anybody's guess. I only hope I can live long enough to see numbers in where it should be. Look, I'm agreeing with all the above. It deserves to be, and it needs to be much higher than it is now, particularly if you look at the reasons why it's not higher. The reasons why it's not higher is because the darn thing has been manipulated, and anybody who looks at it objectively comes to that conclusion after not too long. So once we break that manipulation, which I think we're in the process of doing, the sky's the limit. I could throw out all the numbers in the world, okay, but we have to break the stranglehold of the manipulators, and I think we're doing that.
Well, Ted, our viewers wait with great anticipation of each of your appearances here. In fact, low blood pressure says, Mr. Butler, where have you been hiding? Haven't seen you in a while. Hope you are doing well.
Thank you. Doing fine, and I guess I'm a little bit reclusive by nature, not any specific reason.
Well, I hope you've enjoying your summer. It was a very strange year for all of us. I think this is almost the year that time forgot. A lot of people I've spoken with, and certainly true for myself, feel like there's just this missing 3-month hole in the middle of their time, their sense of time, and how it has passed this summer with the lockdowns and everything that came with it. It broke up our entire life routines and where we could travel and everything. So we're just delighted that we were able to get you back on our calendar, get you in here for this visit with our viewers. I know they appreciate it, and I do to no end. And we look forward to having you back at your soonest opportunity. We've got a potentially contentious presidential election coming up. Who knows what kind of uncertainty will swirl around that. And interesting delivery months approaching on the COMEX, where we're told that they're having to change the rules to accommodate new physical demand that's anticipated or whatever. And just we'll look forward to your continued insight and context that you can bring to us going forward through these unprecedented times.
Look forward to it, Donegan. It's going to be interesting times.
So once again, we've been speaking with Ted Butler, the founder of Butler Research. You can find him online at butlerresearch.com. Also, folks, please do go to libertyandfinance.com. Sign up for our free newsletter right there on the homepage, libertyandfinance.com. Ted, as always, thank you for joining us here on Liberty and Finance.
Thank you. My pleasure.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Donegan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.